Started. Performance of financial statements. The basic set of 4 financial statements, the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows, provide the readers of these statements with a wealth of information, both on historical performance and the ability to go through and make some educated forecasts as to what will happen in the future. And as I tell my classes every semester, doing some basic financial statement analysis before you go to work for somebody will keep you from going to work for Blockbuster. Okay? Don't do that. Because for years, you could tell from their financial statements that they were circling the drain. Don't go to work for Radio Shack. Okay?
Radio Shacks all just closed down. It's the only place that had this little adapter for my wife.
Now you got to go find it someplace else. Yeah. So, the basic objectives is to ascertain profitability, how well is management doing with the assets that they've been entrusted with. As I indicated in Chapter 1, Day 1, there are 2 overarching goals of all commercial operations, one of which is to be profitable. The other is to maintain liquidity. You must have enough cash on hand to pay your bills when they're due. So financial statement analysis will give you some insight into management's performance in maintaining liquidity. And then lastly, what kind of financial risk are they doing? Are they financing expansion with an unusually high amount of debt? So give you some idea as to what they're doing with that. And then the last section here is operating assets. So working capital is current assets and current liabilities. The assets and liabilities that you use and make entries to day in and day out, all throughout the working day. All right? So both creditors and investors, the questions that they want to know is, what is their ability to generate profits, and what is their ability to pay me? If I sell you goods or services and I bill you on a net 30-day invoice, what's the likelihood of you actually paying me? All right? So these are key questions to be answered before you go to business with somebody. The rule of thumbs is there are a number of them. As I go through the various 10 ratios that I focus on, I will be telling you what a general rule of thumb, good business practice is. But having said that, there are some industries in which these rule of thumbs are not exactly the same. A good example, in general, companies pay their bills within 30 days. Net 30 as far as your expectation for receipts of accounts receivable, and net 30 for your payment of your accounts payable. In the aerospace business, that's not the rule. In the aerospace business, primarily, it's 60 days, not 30 days. So if you're going into that business, and if you're going to be dealing with individuals within that business, you should take that into account. Okay? Industry norms are not always easy to determine. Companies out there that are in multiple industries. The one I use all the time is General Electric. You've all heard of the company General Electric. What do? They do electronics, They do appliances, refrigerators and washing machines. They do light bulbs. They also do jet aircraft engines. They're one of the 3 major manufacturers of turbine jet aircraft engines in the world. The other one being Pratt & Whitney and Rolls-Royce. But General Electric has a huge aerospace business. Does lots of government contracting. So this is, so what industry are they in? So that's a good example. So here's an example of segment information that you can get because in the footnotes required by the SEC, you need to subdivide out your business into the same segments that management uses in order to manage the business. Now, a segment can be geographic. That's what this is. Goodyear manages their business geographically. So they have a North American division, they've got a Europe, Middle East, and Africa, they've got a Latin America, and an Asia Pacific. General Electric has a household goods division, an aerospace division, and they also have a capital division where they lend money. That's the one they're trying to sell right now. They're trying to dump that business and get out of the lending money business. All right? So GE Capital is probably going to go away. But you can tell, and it's just basic information, it's sales, operating income, as well as the assets that are incorporated in those various areas. Okay? You also have the ability to pull this information for all publicly traded company. And publicly traded company are anybody with a stock or a debt security on an active market. So if you're selling a bond on an open market, you're a publicly traded company. You certainly are if you're selling stock. Okay? All of this is on the SEC.gov website under a database called EDGAR, E-D-G-A-R. Might be G-E-R. Anyway, it's EDGAR. However, the summary information from this is readily available for all publicly traded companies from 2 sites. You can get the prior 3 years from Yahoo Finance. And that's where I'm going to be pulling the data when I do the analysis starting on Wednesday. You can get 5 years of data, income statement and balance sheet, and statement of cash flows, from MSN Money. So both MSN Money and Yahoo Finance has publicly traded information, financial statements, and it's nice because it's in a standardized format. So if you want to compare one company to another, if you go to their 10K annual reports, they may be slightly different. But both Yahoo and MSN standardize this information and provides it to you in a downloadable fashion so that you can very easily go out, and I'll show you all that on Wednesday. Okay? The other thing that's in here is a 8K report. These are kind of fascinating at times. Anytime there is an important event, you had a changeover in management, you had either the gaining or the loss of a key customer, they have to file an 8K report with the SEC describing that event. So sometimes those can be very interesting, especially from an investor standpoint. So all earnings are not the same. When you're comparing 2 companies, you need to know what accounting methods they use. And my background is the aerospace business, so I always go to there for examples. Boeing and Airbus. Boeing, headquartered now in California, primary operation outside of Seattle, Washington. Airbus, headquartered in Toulouse, France. Boeing files their financial statements under U.S. GAAP. Airbus files their financial statements under the International Financial Reporting Standards, IFRS. The major difference between the two that you need to know about in order to properly compare those two companies' performance, the major difference is how we treat research and development. Research and development, building new airplanes, is a major portion of both of those companies' operations. In the United States, you have to expense all R&D as it's incurred. So every dime that Boeing spends on developing new aircraft, and believe me, it's a lot of money, has to be expensed in the year in which it's incurred, and that directly affects net income. In the European standards, the international standards, you only have to expense research cost. You can capitalize, put on the balance sheet what is known as development cost. The difference between the two is once the item is technologically feasible, and the threshold that I use is that when they get an actual working aircraft as a test bed, put it together, put engines on it, roll it out of the hangar, and start test flight, at that point it's development, no longer research. Because it's not theoretical anymore. It's an actual airplane. And that can be huge. That can be hundreds of millions of dollars. That will make the difference between those two. But that information is available. So if you want to do an apples-to-apples comparison, you can go look at Airbus's financial statements and determine how much development cost was capitalized in the year. And then remove that from their net income, compare that to Boeing's, and now it's the same. All right? You have different inventory methods, as you guys know. What companies are doing LIFO versus FIFO? If they're expensing the current cost of their inventory, their cost of goods sold, in the case of rising prices, is going to be lower than somebody who is doing a FIFO inventory method. Are they doing accelerated depreciation rather than straight line? So all of these things can affect the earnings. So you need to approach this analysis with a little bit of your own knowledge and make sure that you're making a head-to-head comparison. So here's an example. Here's a company. They've got identical net sales. You can see net sales is $462,500 each. But look at the net income before taxes. On this company, Purdy Company, it's $187,500 and it's only $162,000. A difference of $25,000. But what's the difference? The difference is that Purdy Company is FIFO, first in, first out. So their expensing is cost of goods sold, the oldest inventory they have in stock, which, in the case of rising prices, is the cheapest. The other company is expensing the current inventory. As soon as they buy it, that's what they're expensing. Back to Purdy, they're using straight line depreciation. So as they buy new equipment, they're evenly deducting the cost of that property, plant, and equipment over their useful life. Whereas the other company, ASCOF, is doing double declining balance. So they're doing twice the straight line rate. And that's the difference in the $25,000. They're identical other than accounting choices. All right? So quality of earnings affects both income, cash flows, You always need to look at the one-time items on your multi-step income statement. You always want to look at the gains or losses on sale of fixed assets. You want to look at extraordinary items, things that are unusual and infrequent. So those are not sustainable. You want to primarily do your analysis on income from operations. What are they going to be able to do year in, year out going forward? So you have income before operations. They had a write-down of an asset, and they also had a gain on a sale of assets. Those probably do not reoccur in the future years. And then they had a discontinued operation. So that, the gain, the income from the discontinued operation up until it was sold, and then the loss on the actual sale, those are not sustainable. So you need to make some readjustments to that. This restructuring, you'd have to go look at the footnote and find out what's going on with the $150,000 loss on restructuring. So more than likely, those items don't reoccur. You can remove them from income before continuing operations, and rather than using $850,000, so you'd be $1 million, $1.5 million, $1.05 million, $250,000. $750,000 is what your income from continuing operations going forward should be. Okay? So what we're going to do here is two basic analysis: vertical analysis and horizontal analysis. So we're going to analyze the income statement and the balance sheet both vertically, comparing every line on those two statements to a base. In the case... Register now. It won't take long. Yeah, downstairs in my office it would. Well, let's see.
Are you using Chrome?
Yeah, but I'm not signed in. That's okay. Just give me a second. Telling you, less than 5 years. Oh man, 1980. Yeah, it was. College of Business, Accounting, email. Address. There you go. San Antonio. And I am the treasurer. Nobody else. Oh, shoot. And that's it. So I need 2. I don't want that. I don't want to do those. That's free alcohol. Always got to do that. You got to do that. Got to do that. That. Oh, we want 2 for the lunch, and we need 2 game tickets. Boy, they're going to have me pay now? Submit. Oh, man. Well, that's okay. Now I got to turn it off. I forgot I needed to do this part. go to the restroom. We'll be right back. This will take a couple of seconds. 4, 1, 2, 2. There we go. Yes, confirm. And we're in. Thank you very much. 2. Yeah, for a buddy of mine and I. So, and I'll come back there to reserve my room later. So, all right. Back to here. All right. Horizontal and vertical analysis. Horizontal analysis is we're going to compare for the income statement every line item in the income statement as compared to sales. So we will divide cost of goods sold by sales, we'll divide gross margin, the operating expenses, both selling and general administrative, all of the items divided by sales. On the balance sheet, we will divide each and every account on the asset, liability, and stockholders' equity sections by total assets. All right? That's horizontal, that's vertical analysis. Horizontal analysis is comparing one year to the next. And the way we do that is we get a difference between the 2 years. So for simplicity's sake, let's say the gross sales go from $1 million to $1,200,000. That's a $200,000 increase. Divide that by the base year, which is the oldest of the years that you're doing comparison for, and that's a 20% increase in sales. All right? So horizontal analysis is the change from year to year, both the dollar amount and the percentage. So the base year is always the oldest year. So here is Starbucks. Starbucks, and this is their balance sheet first. Starbucks had a $330 billion increase, or no, I'm sorry, $330 million increase in cash. If you take that 330 and divide it by the base year, which is the 2008 number, 269,800,000, that's 122.3% increase in cash. Not a bad year. All right? So that's horizontal. With the income statement, net revenues went down. Because what was going on in late 2008 and 2009? They had that recession, the worldwide recession. So this is Starbucks sales went down 9%. But what happened to their net income? Net income went up almost 24%. So they were more profitable on less sales. So how did they do that? They reduced dramatically their operating costs. They had an 8.5% decrease in operating expenses, both store operating and other operating expenses. And that's, well, the other thing they did was they paid off loans. If you go back to the balance sheet, you'll see that their loans went down. Yeah, the long-term debt. Right there. Okay. Yeah, went down 4%. So, I mean, that's, $50 million, $42 million worth. And so that allowed them to reduce their interest expense by 27%. So the combination between lower operating expenses and lower interest expenses allowed them to increase their profitability even with decreased sales. Yes, sir.
Why would Starbucks be in debt?
Why would they? They go out and I'm sure they finance the construction of new stores, primarily. Yeah.
They don't have the money to do that though.
Yeah, they've got all sorts of cash. Look, I mean, they got $500 million worth of cash, but
why don't they use it?
yeah, staying liquid, to be able to, because they don't have a whole lot. I mean, long-term debt. Well, they do actually. $3 billion worth of long-term. No, $1 billion worth of long-term debt. And I'm sure that's just mainly cash flow. I mean, to cash flow the construction of new equipment, new stores, and refurbishment of older stores and stuff.
You think they'll be able to pay it off?
Oh yeah, without question. Yeah, they've got a good cash flow. So, and they're very strong. And when you look at this, and we'll talk about the ratios here in a second, I mean, their stockholders' equity is $3 billion versus a debt of $1 billion. So that's a pretty strong ratio, 3 to 1 debt to equity. So. All right. So that's horizontal analysis, comparing a base year to the subsequent year. You always want to look at trends. Look at what's going on over a period of time, and that's where that MSN site comes in useful, because you can get a full 5 years worth of data from that site versus what you get from Yahoo, which is only 3. So they look at the percentages of net income. So you can see that the net income is starting to decrease as a percentage of total revenues. So they've had as much as 134% of net income coming from the sales, and it is declining down to operating income down to about 62%. So here's operating income versus, and you can see the drop-off from 2007 where operating income started to decline, even though net revenues held steady until the 2009 year where it dipped. All right, vertical analysis. Vertical analysis is a way to do something, what is known as common size statements. Let's say you open up a coffee shop someplace. You're not Starbucks. So how can you compare your financial statements to Starbucks financial statements? Well, you do them with common size financials. Turn everything to a percentage. So if Starbucks has current assets of 36.5%, property, plant, and equipment of 45%, they've got 7.6% in long-term investments, and that's what makes up their assets. When you turn it to a percentage, you can compare your store directly to Starbucks. Give you some insight into the company leaders. Especially useful when you do it on the income statement side.
When somebody asks to see your financial statements, like if they're coming to join you, or you can say, well, here's a vertical analysis?
Well, your vertical analysis would be useful to present, because that way they can go out and look at other companies in the industry and look to see how you're performing versus the industry leaders. Okay? I mean, are you generating a gross margin of almost 56%? If not, why? Is the cost of your goods too high? Are you paying too much? in order to be able to compete? Are your store operating expenses in the 35-36% range? Is your general and administrative only down in the 4? So you're able to compare by doing these common size statements with vertical analysis companies of varying sizes. And that's can be very insightful. And then the last part of this chapter is we're going to do 10 ratios. All right? So the 10 ratios are going to be looking at financial risk, liquidity, and profitability. Risk is debt to equity, return on equity, and interest coverage. So debt to equity is exactly what it says. Take the total liabilities and divide it by total stockholders' equity. What this ratio shows is that for every dollar that the shareholders have at risk, because the money that they've invested in the company plus the money they've left in the company, in the case of retained earnings, is what they have, that's the skin they have in the game. All right? If that gets too high, you've got too much risk being borne by outside parties. And that should make people nervous. All right? So all that is total liabilities divided by stockholders' equity. So this is Starbucks again. In 2008, for every dollar that the shareholders had at risk, $1.30 was at risk by the people financing it, lending them money. That changed. By 2009, they started paying down some debt, and now the outsiders are only at risk 80 cents compared to the dollar that we're at risk. All right? So that's a very strong indication of a solid company. Return on equity. So of all the equity that the owners of the company have instilled into this organization, this entity, how well are they doing with it? How well is their stewardship of what we're providing management to use? And both cases, 2008, they had a 13.2% return on equity. This is just net income divided by average stockholders' equity. So take the beginning stockholders' equity, add the ending stockholders' equity, and divide it by 2. That increased, even in a period of time where you've got a global downturn in the economy, a recession, Starbucks was able to increase their return on equity up to 14.1%. All right? And when you consider benchmark zero risk out there, which is primarily Treasury bonds from the U.S. Treasury, when you consider that those are paying less than 1% these days, then anything in this range is very, very healthy. This is a good sign. Interest coverage. Interest coverage is to take income before taxes and before interest expense, and then divide it by interest expense. This shows your lenders how many times can you pay their interest. And oftentimes, when you sign notes, loans, commercial loans, they will have loan covenants built in that says you must maintain above a 7 or above a 5 times earnings. And if you drop below that, they can call your loan. You violate the loan covenant and they can go, whoops, so sorry. When do you want to pay me? tomorrow will be fine, today would be preferable. All right? So this one is vitally important to be monitored on a quarterly basis to make sure that you don't end the year by violating your loan covenant. So Starbucks had 9.6 times earnings in 2008, and once again, they were able to increase that up to 15.3. So a very healthy increase, primarily by reducing you see they reduced their interest expense from $53 million down to $39 million. All right, operating. What have they done with the assets that they use on a daily basis? All right, this primarily deals with inventories and accounts receivable. Inventory turnover. How many times a year do they sell all of the inventory they have in stock? So this ratio is pretty straightforward. It's cost of goods sold divided by the average balance in inventory. So take the inventory at the beginning of the year, add it to the end of the year, divide the sum of those two numbers by 2. Starbucks went from 6.7 down to 6.4. So their inventory turnover reduced, but not dramatically. All right? The higher the number, the better. If FedEx had its way, everybody would have a 365 inventory turnover. I had an executive give a presentation one time years ago that said FedEx's dream model, dream customer, is that they open their business in the morning and the whole place is empty. And at 7 o'clock, the FedEx trucks roll up and they take everything out of the back of the FedEx truck and they put it on all the shelves. All of the inventory arrives that day. And then at the end of the day, the same FedEx trucks come back and they pick it all up to ship to the customers. It's crazy. But the higher the better. And in reality nowadays with just-in-time inventory practices and stuff like that, you commonly see this up in the 9-10 range where people are selling all of the inventory they have in stock pretty much on a monthly basis. Okay? Tied to this is how many days inventory do they have on hand. That's just the number of days in the year, 365, divided by the inventory turnover. So Starbucks is holding, well, in 2009, 57 days worth of inventory. And that may be an industry norm. It may take them that long to get raw coffee beans and age them and roast them and do whatever the heck they do to make that $15 cup of coffee or whatever they're charging for that stuff. All right? It may be that they need to hold almost 2 months worth of inventory in order to be able to run their operation. I can't answer that. Same kind of calculation for receivables. The industry norm is 30 days. That's how long most companies allow their customers before they have to pay them. Starbucks collects all of their receivables, so this is net sales divided by average accounts receivable. And they've got a 33.6, 32. Or it takes them only 10 to 11 days to collect their receivables. Now, some of that, once again, is an industry norm. Starbucks is primarily a cash-based business. I don't know who they extend credit to. I really don't. I guess if you buy those little cards, I don't know. I have no idea what this. This is probably franchisees. You know, they've got people who own Starbucks stores that buy their inventory from Starbucks headquarters and then pays them for it. That's probably what's going on here. You'll see this number much, much higher in the case of Boeing, which is the company I'll analyze on Wednesday. All right, so inventory and receivables is 4 out of the 10 calculations that you'll be doing both for the extra credit and for the final exam. The next one is current ratios and quick ratios. So the 4 inventories plus the 3 that we did before, the debt to equity, the return on net income on equity, and the interest coverage. So this is 7 of the total. The last 3 are dealing with working capital. Working capital, it's not a calculation, and when we get to reviewing for the final exam, I will emphasize this. Don't forget that, because I'm going to give you a table of all these, places to put numerators and denominators to calculate ratios. At the very top of that page, there's a line there that says working capital. Working capital is not a ratio. It's not a percentage. It's a dollar amount. It is current assets minus current liabilities. That's what you have to work with. Current assets, remember, is cash, what you're going to turn into cash, what you're going to sell, and what you're going to use up in the next year or an operating cycle, whichever is longer. What you're going to, it's cash, what you're going to turn into cash, current assets. What you're going to sell and what you're going to use up. So you're going to use up all your prepaid, all your office supplies, things like that. All right? Current liabilities are everything that you have due and payable in the next 12 months. So the difference between that is working capital. How much excess over everything that you have to turn into cash versus what you have to pay. All right? That's a dollar amount. And that's at the very top of this ratio page. Current ratio is just the 2 numbers divided. Current assets divided by current liabilities. The rule of thumb is this should be more than 1. You should have more in assets than you have in debt. And sure enough, after they streamlined their operations, Starbucks was able to get their current assets from 80 cents on the dollar up to $1.30. Okay? The last of the 10 ratios is what is known as a quick ratio. A quick ratio is if you had to pay off all your current liabilities by the end of the week, could you? So this is cash, marketable securities, and accounts receivable. What could you turn into liquid assets in a week's time? It does not include inventories. It does not include prepaid expenses or any office supplies, cleaning supplies, or anything like that. What could you turn into cash within days? And Starbucks used to be able to pay only 30 cents on the dollar by the end of the week, but they got it up to 60 cents. So they've been improving that ratio, trend analysis once again. They've been improving that ratio dramatically. All right? And that's it. Questions? 10 ratio.